What is tax loss selling and how can you benefit from a proper tax loss selling strategy? Let's get into it right now. I'm Rob Tatro from robtatro.com, portfolio manager here at Canaccord Genuity Wealth Management and the Tatro Wealth Advisor Group. Tax loss selling. It works. It can save you tax dollars, provided you have the right strategy. Let's get right into it. So, a reminder, if you're watching on YouTube, Instagram, wherever you're watching, take a sec to subscribe, take a sec to like, put your comments below. We'd love to hear what your thoughts are on this. And if you'd like to book a no obligation consultation, please go to www.speaktorob.com. Give us a follow, all right? We put out some good content. Let's get to 10,000 subscribers. Tax loss selling. Typically, the strategy involves selling an asset that you've bought, which has fallen in value, and replacing it with a similar asset. So the reason we would want to do that, first of all, it's got to be done in a non-registered or a corporate account. Why is that? Because those are taxable accounts. Okay. It cannot happen in an RRSP account or a tax-free savings account. You should never be talking about tax loss selling in a registered account, whether it's an RESP, an RDSP, a RIF, a LIRA, TFSA. You should never be talking about tax loss selling in those accounts. It can only exist in a non-registered account. You likely know this, but you declare taxable income and you must pay taxable income on your capital gains. So if you make a gain in an investment, a stock, you bought at $1, you sell it for $2, that is a capital gain, which you then have to pay tax on. Depending on your tax rate, it's typically at the top tax rate around 25%. How do we avoid that? So one of the things you could do is if you have losses in your portfolio, so positions that you bought that have fallen dramatically for whatever reason, and let's not get into why you might have loss in your portfolio, but let's just say you do. Maybe you bought a cannabis stock and it fell a ton and you still like the sector. You continue to want the sector. You want exposure to that sector. So a strategy could look like this. You would sell the stock that you own. You would replace it with a similar stock in the same sector, or you would replace it with maybe an ETF, an electronically traded fund, because you still want to have exposure to that stock. So you sell one name, you buy another name, and you do that. Now, maybe you still like this first name here, right? And you want to get back to this name. So the rule with CRA is you cannot repurchase it within 30 days. Okay. So you sell a stock, you wait at least 30 days, and then you can rebuy that. Why is that? Because CRA considers it a superficial loss. In theory, let's say you were just allowed to sell a stock today and rebuy it tomorrow just to crystallize the loss. CRA doesn't like that, all right? Because it's not a real loss. It's a superficial loss. So what you need to do, you need to sell the position, you need to exit the position for at least 30 days. And the key is that you probably still like that sector if it's down a ton, or maybe you don't. Maybe you just want to sell the position and get the heck out of Dodge. And if that's the case, you don't need to buy another position, but that would be tax loss selling as well. Typically, the tax loss selling strategies involve you sell a specific stock that is down a ton, you replace it with an equivalent, and 30 days later, you flip the trade and you go right back. The reason you want to do that is in case there's a run on your sector, you want to make sure you have that exposure to that sector. This will oftentimes happen in sectors that are highly volatile. Cannabis is one, crypto could be another, oil and gas could be another, mining could be another, tech for some periods of time could be another. So if you're buying these sectors that have a ton of volatility, and maybe you're at the downswing in the volatile sector right now in the volatile cycle, you replace, exit, 30 days later, you go back, you've now crystallized a loss, and all of the gains that you're going to get in the future are now going to be deferred because you don't need to pay tax on those gains till the future. You can then offset your losses against capital gains as well that you've created. So it does in fact reduce your bill. And if you have no losses, you can offset them in future years. All right, hopefully that makes sense for you guys. Thanks for tuning in. Appreciate you taking the time. If you'd like to book a no obligation consultation to chat about this, go to www.speaktorob.com. We'd love to book a chat with you to chat about this or anything else that's on your mind. I'm Rob Tatro from robtatro.com, portfolio manager here, Canaccord Genuity Wealth Management and the Tatro Wealth Advisor Group. Thank you guys for tuning in. Now you know how tax loss selling works. Thanks. Have a great day.